Hi, today we're going to talk about traditional versus self-directed mortgages, and without further ado, let's jump right into it. So the first thing is traditional mortgages, and our second thing is self-directed mortgages. Now for traditional mortgages, the difference is it has compound interest, there's no control of payment and interest, and we end up paying 2 to 3 times over. Now for self-directed mortgages, we have simple interest, we have full control of payment, and we pay off our mortgage in half the time. So if we draw a simple graph here to explain what is actually happening, you can see that at the top here, this is our payment line. That's how much we pay every month, regardless of whether we're on the traditional or self-directed timeline. So the orange line shows our traditional interest payments. So you can see that in the beginning of our mortgage payments, we actually pay quite a bit of interest. So that would be our dollar value. The vertical line would be our dollar value. And we see that we actually pay a lot of interest. And as we get close to the 35-year mark, or as we move on towards time, we actually see that the interest becomes smaller and smaller. That is because of the compounding rule. Because we are paying more money and our principal is being reduced as time goes on. We pay less interest as time goes on. But at the start, we end up paying a lot of interest. Now, self-directed mortgages is a little bit different because of the way it uses simple interest in that the interest we actually pay is consistent over time. So from the start till the end, we actually pay the same interest. So if your interest is $1,000, then from the beginning of the year to the last of till the 35th year, you'll actually end up paying $1,000 each month. So that's the difference between self-directed mortgages and traditional mortgages. The difference with self-directed is that with self-directed, you always pay the same interest, but you have full control of your payments. So say if you always pay $3,000 every month, you end up paying $1,000 of interest. That $2,000 is something that doesn't change. But with traditional interest, you don't know how much interest you're paying each month. You actually know when you calculate it, and you actually don't know how much of the $3,000 that you pay actually goes to principal. So with self-directed interest, we can use that $2,000 as a way to invest into products. So by products, I mean things like mutual funds or stocks or any kind of financial product. So by using that $2,000 to invest, we can actually make more money via a better A situation. And I explained better A situation in one of my other videos, so I have a link to that. You can check it out if you want. But um, this is your video on traditional versus self-directed mortgages. Please rate, comment, subscribe, and I'll see you guys again next time.